President Meirelles will be joining us soon, the governor of the Brazilian Central Bank. But so you're going to have a panel. Each one will have about 15 minutes, okay? And then the governor will have the last word. And then we'll have a little discussion between ourselves before. So let's start with Professor Kiyotaki.
Thank you very much for. So the title of our panel is what we have learned from this current turmoils, and I'm going to think about from analytical point of view. And the first things we learn is people may default, basically. So we have to take account the constraint of default rather seriously. And so is that make it, can you make it big?
Page down.
No, make it to be big, control plus. Okay, yeah. So basically the people may default, and therefore the people's ability to commit to repay is limited. And so important lesson for economics is therefore not every asset is pledgeable or becoming the collateral for the loans. And second lesson is even if you can borrow, not every pledgeable asset is liquid. For example, I may be able to borrow from Professor Araújo, so some amount, and when I write IOU to the professor, but the professor have a lot of difficulty to sell my IOU to the other peoples. And so in this case, my commitment is pledgeable, but not the liquid one. And so not every asset is therefore pledgeable, and not every pledgeable asset is a liquid asset. And the current turmoil, first approximation, you can think of the liquid asset is shrinking. Fraction of liquidity is shrinking. Like all days, the mortgage-backed security is reasonably liquid. Now the mortgage-backed security is no longer that liquid. And if that's the only reason, then you might say, why we care? Like some people gain, some people lose. And but what for economists we care is the page down. Sorry. Okay. Oops. Going. What we care is because the allocation is affected by the variation of the assets. So allocation and variation of assets is closely related. The reason is the assets in our economy, when it's pledgeable, it's acting like a collateral for loans. Simultaneously, these fixed assets, like real estate or machines, is acting like a factor of production. Basically, fixed asset has playing the dual role for the production, factor of production, as well as collateral for the assets. Then the amount of debt people can borrow depend upon the amount of assets people hold, as well as the collateral value of this asset, collateral price of the asset, how much you can borrow per unit of the asset. And the people who is using this asset for collateral is going to have a relationship like asset demand, like a purchase of the assets, price of the assets times the net purchase of the assets is financed by either return of assets from previous period or the new borrowing, and after repaying the debt. So the assets held at the end of this period depend upon the bottom part, which is how much assets you can borrow against it. The price of the assets you have to pay, but the amount you can borrow, you don't have to finance yourself. And the amount you have to finance is the gap between the asset price and how much you can borrow per unit of the assets. You might call it this as this down payment constraint, or you might call it as a margin call. And how do you finance this, the down payment or the margin call? It's coming from the net worth. Net worth is the return plus how much assets you held from last period minus how much debt you pay. So that's the net worth. And the curious things about this asset market, asset demand, is the asset price appears both the top defining the net worth as well as the bottom. And if the asset price is going up, the bottom part is going up. Perhaps the collateral price is also going up too. So bottom one is more or less moving proportionally with asset price. But net worth is leveraged by the debt carried from the last period. So if the debt carried from last period is bigger than the return, then actually the net worth is going up more than proportionally than the asset price. And as a result, what we got is sorry, it's a little bit too small, so make it to be big. So what we got is something called balance sheet contagions. And you probably don't see that, sorry. So what we got is basically if you have some, what we, people probably don't see that. So I will explain by looking at the equations. What people will see is basically the asset price appears both how much you pay after you borrow from there. And so this is a margin call or the down payment requirement. But the top includes how much assets carried from the last period. And if you have a huge debt sitting there, actually asset price go up is a good news for you. So the constraint people actually buy more assets when asset price is going up. And this is paradoxical from usual demand theory. When the price go up, the demand is going up is kind of completely opposite from normal case. So what happened is if people who is constrained is going to lose some returns, they demand less assets. But when people demand less assets, somebody has to buy it, which is the people who have a lot of wealth, like a Warren Buffett. But for the Warren Buffett to buy, the asset price has to go down. But then when asset price go down, this constraint people who is shorting cash or the investment banker, they have to, their net worth is going down. And as a result, the investment bankers or the constraint people's purchase of assets go down further. And then this will create the vicious cycles and the misallocation of resource. Basically, constraint people give up the assets and they have to sell to the rich people who may not use the assets most effectively. And that's why you got this, the misallocation of resource may expand when the asset price starts going down and the credit constraint gets tighter. And the remaining question you might ask is why the liability is not indexed. Like if your asset price goes down and the liability automatically shrinks, then you may not get this kind of leverage effect. The problem of the constraint people is the debt doesn't go down together with the asset price. If the debt is more soft liability, which is like it's like an equity contract or index contract, then asset price go down, but the debt will also partially go down, then you will not have this leverage effect or the demand is increasing function of the asset price. And so the question is why debt is not fully indexed, or the people don't use the equity contract, or why the people don't provide the equity to the constraint people, constraint agents who are short in the equities during the crisis. People call it this as sticky equities. Why people don't purchase the bank's equity during the crisis? If the people buy the equity during the crisis, you probably don't need the government involvement to pump in the public money into the banking system. And here we think the limited market participation may be another important element. Basically, not everybody is actively participate the market. Like a household or small guys is only participate the market, the wholesale market, through the intermediary. I call it the bank. And then what happened is the bank's liability is the bank's balance sheet. Can you see it? Oops, this might be, sorry. The bank balance sheet asset side is the contingent asset, which is moving up and down with asset value. But the liability is against the layman, like a household or small business. So they are not participating in actively the asset market. As a result, their liability is not fully contingent. And as a result, the bank's balance sheet has a feature like asset part is moving up and down with asset value, but the liability, like a deposit, doesn't go up and down with the asset value. And all the effect is going to the bank's equities. That's why we think the question like people's liability is not fully indexed and also not fully contingent, and also people's participation into the purchasing equity, bank's equity is rather limited. So I will stop there.
So thank you very much. Professor Sims now is going to make
Do you know which slides are mine? I was number 3. I'm not going to talk about the whole crisis, and I'm not going to talk about anything we've learned. I'm going to talk about some things we have to unlearn. And I'm going to center my discussion on the balance sheet of the U.S. Federal Reserve, because it's one of the things that's most dramatically changed. We don't actually need that yet. I don't want you to look at that yet. It's very complicated, and you're not prepared yet to understand it. So the first question is, why does the Fed balance sheet matter at all? Many economists have the reaction, the Fed balance sheet is a figment of your imagination. One reason people say that is the Fed can print money. So unlike a private bank, which might not be able to pay for the new computers it's ordered if it gets into the red, the Fed can always print money when the computer delivery man comes to the door. So there's no chance that the Fed cannot pay off liabilities it has, whether it's in the red or not. That's true, but it only doesn't matter if the Fed doesn't care how much money it prints. In other words, as soon as a central bank starts to care about the inflation, in other words, has a commitment to trying to maintain a certain rate of exchange between paper money it issues and some kind of real goods or assets, the central bank's balance sheet starts to matter. Another way to think about that is a central bank that's independent, doesn't have any direct access to the tax power, has only one source of revenue, and that's seigniorage. So if it gets deeply into the red and has no option for getting out of the red except seigniorage, it of course has to limit the extent to which it tries to keep inflation under control. The other argument you'll hear sometimes is there's really no central bank balance sheet. There's a government balance sheet. The central bank is part of the government. It's just an illusion to talk about or even worry about the central bank balance sheet. And that, again, that's got a grain of truth in it. If the Treasury and the central bank are really one unit, there's no point in talking about separate balance sheets. But in most countries these days, the central bank and the Treasury are not one unit. In fact, most countries have moved towards what we call independence of the central bank, which tries to limit the contact and amount of discussion between Treasury and Congress and the central bank. It's always true that the central bank has impacts on the budget. So in some sense, monetary policy always has fiscal implications. Most central banks regularly turn over seigniorage to the Treasury, and that can be a non-trivial part of the Treasury's budget. And central bank actions to change interest rates change the interest expense component of the budget, which in many countries is large. What we mean by central bank independence is a convention that the legislature and the Treasury are not supposed to bother the central bank, at least not too much, if seigniorage fluctuates or if there are changes in the amount of interest expense in the budget due to central bank actions aimed at controlling the price level. But this is a convention, and in fact, I think of the central bank balance sheet in a situation where you have central bank independence or something approaching that. The central bank balance sheet is really the field on which the game of fiscal monetary coordination is played. And in the current context, what the Federal Reserve has done is change the game from something like ping pong to something like football. The U.S. Federal Reserve used to have a balance sheet that had, on the liability side, cash and non-interest-bearing reserve deposits, and that was about it. That covered most of it. On the asset side, it had fairly short-term U.S. Treasury obligations. So the risk on that balance sheet was essentially zero. There's no foreign exchange risk because there were hardly any foreign exchange reserves, and anyway, those are held by the Treasury in the U.S. So there wasn't a chance of a sudden devaluation affecting the balance sheet. And because the assets were short, there was little chance that sudden changes in the interest rate could create any problems in the balance sheet. And the Fed carried very little capital, and nobody cared how much capital the Fed had because there was no chance that it would go into the red. The U.S. Federal Reserve balance sheet has completely changed in this respect. Reserves are now interest-bearing. In fact, what you learned in textbooks, if you used a U.S. textbook, you learn about open market operations in which, and an open market operation is the Fed buys or sells Treasury bills, and that changes the amount of high-powered money, and there's a money multiplier. That's all obsolete. That's not the way it works in the U.S. anymore. So now we're ready to look at this table so you can see what's going on. This is the asset side of the balance sheet. And the first column is the asset. This is all millions of dollars. First column is assets for the week ending November 19th. That's this last week. The second column is the change from a year ago. Now, one of the interesting things about the table is that many of the entries are almost the same in the week ended November 19th and changed from a year ago. In other words, many of these entries did not even exist a year ago. A year ago, I've got one more slide, which is the liability side. A year ago, the liabilities, you could get them all on one slide. Now there are not only many more entries on both the asset and liability side, there are 16 footnotes and 2 supplementary tables. It's getting like reading the Enron balance sheet if you really want to understand what's going on. So what is, see how this works. The first and maybe most important thing is that the change in total Reserve Bank credit is more than half of the total. So the balance sheet has doubled in the last year, and in fact, most of this change occurred in the last 4 months. If you had told most monetary economists a year ago the Fed was going to double its balance sheet in 4 months, they would have thought inflation is going to be going through the roof, because people would have thought it's doing that by printing money and buying treasury bills. But that's not what it's doing now. The other thing is, look at securities held outright. That was basically treasury bills before. That's gone down by over half. U.S. Treasury bills U.S. Treasury securities in particular have dropped drastically. What's gone up are all these other things: repurchase agreements, term auction credit, other loans, and primary dealer and broker-dealer credit, asset-backed commercial paper, money market, mutual fund liquidity facility. These are things that are the same on the left and right column. Net portfolio holdings of commercial paper funding facility, LLC. That's a subsidiary of the Fed that owns stuff, and there's 265 billion there. And then there's this mysterious other Federal Reserve assets line, which I had to ask people about. 2 weeks ago, there was no way from this Federal Reserve statistical release, which is H4.1, in case you want to keep track of it week to week. It's always different, so it's worth looking at. They didn't even have an explanation of this other Federal Reserve assets, but it's actually mostly the swap the Fed has been doing on a large scale, swapping with foreign central banks. So it's now got swap agreements with foreign central banks that have an asset and a liability side there. Now I guess there's one other, can we go to the next slide? Oh, here. So this is the liability side. The most interesting thing here is this entry, U.S. Treasury Supplementary Financing Account, which you'll notice is the same in both columns. That is a little bit bigger than the total Treasury asset holdings of the Fed. So why did the Treasury make this huge deposit? What happened is, as the Fed began to do more and more discounting of private assets, or swaps in which it swapped out Treasury bills for private assets, it got to the point where if it wanted to do a contractionary open market operation, it was stuck. It didn't have any securities to sell. This is actually the nitty-gritty of how difficulty in controlling inflation shows up when your balance sheet starts to get into difficulty. They didn't have highly liquid assets. So they went to the Treasury. The Treasury essentially gave them a whole bunch of bonds in return for a liability, which is so there's an account, which is a liability to the Treasury here. And that's essentially the entire source of Treasury bonds that they now have. So what does all this mean? The consequences of it, it's hard to say, actually. One consequence you can see is that the simple model that, well, I guess one other thing that's very important that I should mention is they're now paying interest on reserves. So excess reserves are now most of reserves. It used to be that reserves pretty closely tracked required reserves because they paid no interest. As soon as a bank got a reserve deposit account, it tried to lend it out. That's the money multiplier you learn about in Ec 1 from US textbooks. But now everybody's looking for liquidity. They're paying interest on reserves at roughly the Treasury bill rate. So it's actually quite attractive to keep money in reserves. You don't need to lend it out right away, especially if you're a little afraid about your balance sheet. So there's huge reserve balances with the Federal Reserve, but they're not resulting, this is not expansionary in the same sense that it would have been a year or two ago when there was no interest being paid. This is actually, I think the reason they asked for this was part of the TARP, the big $700 billion bill that went to Congress. It didn't get much discussion because of the $700 billion overshadowing it, but there was a provision allowing the Fed to pay interest on deposits. They wanted that, I think, to be sure that they had a way to take contractionary actions, even if their balance sheet was all tied up in real assets. The other thing is just huge increase in uncertainty here, because these actions, which I think these actions of buying private securities, making essentially are taking on credit risk. The asset side of the Fed's balance sheet no longer is essentially risk-free Treasury bills. It's trying to keep the risk limited, but it is taking on risks. So its actions are combined fiscal monetary actions. They have some consequences. They could require backing from taxes if the assets don't don't turn out to be as valuable as the liabilities. Of course, it could go the other way. If this all turns around in a couple of months, the assets may turn out to be worth a lot. The Fed may end up with a profit, and there could be no problem. That's why it's tremendously uncertain at this point. The other thing that's important, so it's uncertain. They've created some balance sheet risk, and we don't know what will happen if it turns out that they make losses and go into the red, because there hasn't been any tradition of interaction between the Treasury and the legislature on this. It was a good thing they went to the legislature over TARP and got the approval for the interest rate, paying interest on reserves, because it meant that Congress is sort of in on it at the start. They didn't do all this stuff and then wait for Congress to discover that it had happened a year later. I think there's still a lot of room for second guessing and for congressional hearings saying, how did this ever happen? Did we ever approve it? And that's something to worry about. The other broad thing to worry about is, how do we rethink the notion of central bank independence now? These Treasury deposits, if you're really worried that the Treasury can pressure the Federal Reserve, there's lots of leverage now for the Treasury in the U.S. And we don't have the convention we had before of you just ignore seigniorage and interest component of the budget the way we did before, because the new problems are there's going to be seigniorage is going to go down if they try to use the interest on reserves as a contractionary measure, and this risk may force interaction with Congress and the Treasury. In fact, there's even some people question whether the Treasury creating debt to give to the Fed in return for deposit liability is just what is the legislative foundation for that kind of action. It's essentially creating debt that could require tax backing without any direct congressional action. So there's lots of room for things to go wrong or for things to need changing. And we're in a very uncertain world. So I hope I've convinced you that there's stuff you used to know that you don't know anymore.
Thank you very much. The next speaker is Patrick Honohan from Dublin University.
Thank you very much. Well, I want to discuss the containment and resolution policy that has been operated during this crisis, talk about whether it's been any good, and talk in a little bit... You've taken it away. Talk about whether it's been any good, obviously with the benefit of hindsight. The background is my perception, and I think it's a common perception of what the distinctive feature of this crisis is. Remember, we shouldn't have had this crisis. We've spent a lot of money and resources on thinking about how to prevent systemic crises, and a lot of people thought they were over, at least in the advanced economies. They were not over, something happened. So it must have been something that wasn't expected. It's not just fear and greed. They're always there, and a number of other things are always there. There must have been something new and distinctive. And what's new and distinctive this time is that there were new risk management tools available and being widely used in the banking system and by regulators, and there was overconfidence in these tools. People thought they were better than they were. We, I think, in this room would have known their limitations. We would have worked through the mathematics and known the assumptions. There were very restrictive data inputs that were going into them, the simplifications that were being made, but practitioners used these models, and a lot of the models were actually proprietary, not discussed widely in the public. So why did I think there wasn't going to be a crisis like this? Because I thought the models were better than the ones that I saw in the literature. I thought, well, they got some great people to refine and advance and improve these models. So I need to move this on from time to time. And now, of course, there's revulsion because people realize, bankers realize, that their models were no use. And they also realize that the other guy's models are no use either, so be careful about lending to that guy. And the regulators realize, but they realize more slowly, the same sort of thing. So the revulsion is massive because people no longer have a system that they trust. They have to replace that system, and that's still in process. So that's the background. So that's, in a sense, the failure of crisis prevention, but it also informs the way in which the containment and resolution policy has been operating. Now this happened yesterday. I saw somebody had this problem. You have to move closer to the machine if there's to be a reliable reaction. Do you remember that happened yesterday? Yeah, okay, now it's happening. No, you've got this one here. I just want to see what I'm doing here because I didn't get any printing possibilities. But now it can. Why is it not reacting? There we are, okay. The overconfidence in these systems was widely shared. I just give you names of two big banks, a big bank and a small bank. UBS, winner of Euromoney magazine's Global Best Risk Management House Award for Excellence in 2005. In 2007, it lost $44 billion on this stuff. Northern Rock, they were doing other stuff. They were borrowing. They were in the wholesale markets, and they were the winner of the International Financing Review's Financial Institution Group Borrower of the Year Award in 2006, and they couldn't borrow anything in September 2007. And regulators shared the same rose-tinted spectacles. Not only that, Basel II approach, relying on internal ratings, implies that the regulators actually buy into the bank and or the rating agency models. So they've got to. If they're not happy with the way the bank is assessing risk, then they have to do something about it. So they had to see it through the same eyes, and so they couldn't have detected this particular problem. The problem The fact that there was a problem is revealed by this graph that you've seen many times. That's the one carrying it right up to date. The interbank rate, the LIBOR rate, 3-month, and the relevant OIS rate, and how they moved almost identically for years until they split apart on August the 7th. Now that should have been the signal to do something. And indeed, some things were done, but not enough. So what's the standard prescription? What should have been done on this? Okay, you should have legal powers enabling and requiring the regulators to do a number of things. First of all, intervene in undercapitalized banks. This is what the textbook says, requiring them to increase capital, take control of a failing bank, arrange for sale, liquidation, or financial restructuring with the use of public funds. This is textbook. Normally, the textbook also suggests you should have a limited deposit insurance to insulate small depositors from anxiety and loss. And there should be liquidity provision to stabilize monetary conditions, including a lender of last resort, but only for solvent liquid banks. Okay, so let's look at the effectiveness through this. Legal powers, even the UK and the US were not ready. In Northern Rock, they had the situation, I don't think we can really lend them, I don't think we can really intervene them. EU law seems to, state aids, we don't really have special bank insolvency procedures, so they were stuck. And they ended up having to nationalize the bank under political pressure. Lehman Brothers, I don't know, but I read in the Financial Times that it wasn't because they wanted to demonstrate to the general public that not every bank was going to be saved, but because on Sunday afternoon, when the private rescue measures had come to nothing, they did not have a legal way of intervening and preserving that bank's business on an ongoing basis. So legal power is not there. Deposit insurance, well, it did not play a constructive role in this crisis. Of course, it can only play a very limited role. I won't take time over that. But let's look at the various things that happened. Northern Rock situation revealed the inadequacy of the British scheme. The first £2,000, that's about, well, not very much now, it's about less than $3,000, was covered in full, and 90% of the, well, if you want to have a system that's going to make people run, do put in something like that. It was supposed to encourage depositor discipline. Well, you know, I have a deposit in excess of £2,000, but I really don't know how to exercise discipline on Barclays Bank. So that failure of that system made the rescue politically inevitable, especially when they didn't have the legal powers. In DMAC Bank, extraordinarily, even the well-operating FDIC system, extraordinary experience of paying out promptly, usually the next day your deposit is secure in another bank. Even covered depositors ran despite the prompt payment record of the FDIC. And cross-border issues remained unresolved, even though people had been talking about them for years. The Iceland Bank case is extraordinary, where the British government used anti-terrorism legislation to grab the resources of Icelandic banks left in London to make sure that the depositors were being paid because the government of Iceland couldn't afford to cover them. So that's deposit insurance didn't do so well. I'll come back to bank intervention, but liquidity policy. Well, we've heard a lot from Professor Sims about the Federal Reserve's extensive interventions in liquidity policy, and it's true that there's been a very big expansion. All the major central banks have innovated in terms of instruments, maturity, counterparties, but they have maintained, I'll put inverted commas, high collateral, because I don't want you to come back in a year's time and say you said they weren't going to lose anything, but they certainly haven't been in rescue mode. They've been in liquidity provision mode, and they think that they are reasonably well covered. Even in early September, the European Central Bank tightened its collateral rules in order to protect itself against credit losses. They don't envisage that they are taking credit costs here, and they mostly stayed out of explicit rescue actions. There are a few isolated cases. Northern Rock, of course, again, Bear Stearns one of those items on the balance sheet is there. There's something to do with some funny name on it. It's a special account, AIG. But generally the central banks, unlike in past crises that have been studied all over the world, central banks have been in the front line for providing basically solvency solution. It's not clear that they're in the front line for losses here, although of course the quality of their collateral may deteriorate. And therefore I interpret that their operational independence and inflation targeting is not yet really compromised in this crisis. However, they have not been able to control money market rates with precision, as we saw the big divergence of interest rates there, and that is an interesting, also a deficiency and in a sense a failure. Now to come to intervention and recapitalization, which is the heavy one. Despite the alarming indications that problems were serious, I think we'll have to say with hindsight that intervention, resolution, recapitalization has been slow. The initial reactions were reactive, yes, reactive to cases of we've run out of cash, case by case basis, piecemeal. Now, one piece of information about this is that previous banking crises around the world created huge fiscal costs, taxpayer costs, but by end September 2008, even if you made a pessimistic assessment of the ultimate cost of the fiscal interventions that had been made in this crisis so far, after over a year of the crisis, you get a plot like this. Now, this is my data, 74 countries of fiscal costs as a percentage of GDP on the y-axis, going up to 55% there. It was in a country neighboring here. And I plotted it just against GDP per head, just so that you know it's not just, Patrick's always interested in poor countries. So some of these are not very poor countries. I have a big red spot there. I put that red spot in around June. And by the end of September, it had my estimate for this crisis had edged up towards the top of the red spot, but it was still valid. Very tiny percent of EU plus US GDP in terms of fiscal costs. In other words, the fiscal authorities, and let's face it, they're going to pay for most of this, they hadn't started to do it yet. So that's over a year into the crisis. And now they're doing it. The reason, I won't take long on this, the reason that they didn't, they reacted first of all to the ruined gamblers, a few German banks like Saxon Bank, the other one whose name I've forgotten, they just intervened. These were silly banks that got in well over their depth. The next lot were banks that were opaque. The market couldn't trust them. There was a sort of sequence of different types of banks that were intervened really at the last moment that you could intervene them before they collapsed. We're now in the last month or so, into dealing with the over-leveraged mortgage lenders. Well, it started with Fannie and Freddie, and you've got the big British banks that are being saved. And then we have the diversified survivors question mark, which is the big banks that they were losing money in part of their business, but not throughout their business, so they were able to, if you like, cross-subsidize. Because there were three waves of this loss. There were the losses due to the complex mortgage-related securities from mid-2007, and then there was the realization sometime in the middle of 2008 that conventional mortgages was an even bigger problem, and now we're into the third range of losses of recession-related. And I think you've all seen this graph, which is actually not the most up-to-date one, which shows how even in conventional mortgages, you see on the left-hand side the most recent maturities, and there's no indication yet of a stabilization or a steadying out of the losses due to coming from the recent cohorts of mortgages. Even conventional, compliant, whatever they call them, mortgages, not subprime, it looks as if delinquencies, default rates are going up, and we don't know, and nobody has a good model that says when will these curves start to turn and stabilize. So the huge losses coming up in the mortgage securities. We knew this months ago, but nobody was intervening on a large scale. Now, having said that, there is one positive thing, and I want to say this because there's a tendency to believe that moral hazard has just gone wild in this situation. But we should recognize in the containment and resolution policies that have been adopted so far that there have been losers. Bank shareholders, list a number of banks that have been completely wiped out, and remember that a lot of other banks, the shareholders have been almost completely wiped out. So Citibank, 90-something% share losses, Royal Bank of Scotland, well over 90%. Bank of Ireland, I hold shares in Bank of Ireland, 96% loss last week. So we paper the walls with them. Debt holders in a number of big American banks lost, and even depositors in the Icelandic banks. So let's not think that everything has been covered and that there's been complete blowout of moral hazard. Yes, there are moral hazard problems, but it could have been worse. Right, I'm going to just talk very briefly about for the future. A number of things that you could say. You could have 10-point items, 15-point items. I'll just make 3 points. Yeah, market information and intelligence is very good for micro supervision, and it can also be useful, though, I think, for collecting, as an input into assessing systemic risk. I think what the failure here was not to realize a year ago that we were into a very big systemic meltdown situation. We don't have good systems for processing that kind of information. We have the financial stability reports that central banks are preparing all over the world. They're not really doing the job, but they're nice. I like, I like the quality of the graphics and the analysis, but they are not actually getting to the point where they are telling high decision makers, we have a turning point here, we have something very serious. The IMF, World Bank Financial Sector Assessment Program, they do stress tests, but those stress tests fight the last war. They're not really forward-looking, they're not really telling you what's going to happen. There are contrarians in every banking system, in every economy, there are contrarians who are around there saying it's going to be very bad. I think we all have friends in each of our countries that, oh, it's very bad. And they've always been saying it's very bad. But sometimes these guys have a point. And we need to listen to them, and we need to have a way of listening to them and a way of processing the information. We typically dismiss them. I mean, Nouri al-Rubini has been saying this crisis is coming. It's coming. He's been saying it for a very long time. I dismissed him, not because I thought he was foolish, but because I thought he didn't know the inside details. He didn't know just how good Citibank's risk management systems were. He didn't know all the stuff that the bank supervisors do. But there should have been a way of getting the Nouri al-Rubinis of this world into a room with the bank supervisors so that they can thrash out exactly which of them is wrong. Organizational economics may help. There's a nice paper about the 9/11 intelligence failures. I don't know that literature very well, by Caricano and Posner, but they point out the sorts of organizational economics reforms that you might need to do to make sure that you are collecting the right information and processing it properly. The other, for the future, much more capital. I think there's no disagreement on that. Over-complex and opaque instruments, they may be outlawed. I think they will be outlawed. What seems over-complex in this room, of course, that definitely should be outlawed. But what seems over-complex to the plain person, it's not so clear. So I think this is where the economics profession has a real contribution to make, to tell people what's understandable and what's not understandable. And what's not understandable is 300 pages of legal fine print on a complex mortgage-backed security. That's not understandable. Nobody reads the 300 pages. Can we find a viable and effective way of reducing reward asymmetry? I haven't really heard it. Okay, that's the summary. The recognition lag was too long. Interventions were reactive to cash crunches. And it was because regulators had bought into the overconfidence in risk management tools that drove the excessive expansion of capital and liquidity leverage. And they were slow to realize that revulsion had set in. I'll leave it there. Thank you.
Thank you very much, Patrick. Next speaker will be Charles Calomiris. We're going to have about 20 minutes.
Good afternoon. Okay. That's fine. Thank you. I'm going to give a brief version of the speech I'm giving, I guess it's actually day after tomorrow in Sao Paulo. So I advertise in case you're in Sao Paulo, maybe I'll see you again. And what I'm going to do is focus on the U.S. experience, and I'm going to do a few things. First, I'm going to ask a broad question. What are the lessons about why this crisis happened and how it affected the financial system from a broad historical perspective? In other words, suppose that you were actually knowledgeable about how financial crises like this one had happened in the past. What was not surprising and what was surprising? And in looking at that, I'm not going to look at all financial crises, but crises like this one in the US. And by that I mean crises that had to do with a real estate boom and bust that had a large involvement of banks. And I'm going to think about that question from the perspective of very large boom and busts involving real estate and bank lending throughout the world for all of known history, okay? And I'm going to then ask two parts to that first question of what's old and what's new. What's old and what's new about the origins of the crisis, and what's old and what's new about the way the crisis proceeded and how it was transmitted through the financial system, okay? So the first thing is, what's old and what's new? How surprised am I as an expert on the history of crises about the origins and the propagation of this one? And then after that, I'm going to turn to the second part of this, which is, what is it telling us about policy? So let me summarize for you pretty quickly the first part. If you were looking at the subprime crisis through the lens of historical real estate-related banking crises in the past, and if you're looking at the origins of the crisis, there's some things that are very old hat. What's old hat? First, these kinds of crises tend to happen in situations where monetary policy is very loose, where there are negative real interest rates. In this case, I'll show you evidence that with the exception of the period 1975 through 78, real interest rates in the US were never, in the post-war period, were never as low as they were from 2002 through 2005. And in fact, to make matters worse, because of the Greenspan conundrum, that is because the term structure was flat during this period, those real interest rates applied not just to short-term rates, but also to long-term rates that are more relevant for mortgage markets. So the first thing that's not new is when the Federal Reserve or when a monetary authority decides to run extremely accommodative monetary policy for many years in a row, it tends to make a lot of money slosh around in the system, and we tend to see less wise investments. That's something I think we've seen before. By the way, monetary policy was accommodative also from the perspective of the Taylor rule. That is, any reasonable version of the Taylor rule would have predicted much higher interest rates than were experienced during 2002 through 2005. The second thing that's old hat is there's a huge amount of subsidization of debt, real estate related debt, that was going on in the US. And in most of the major crises, all of the really severe housing booms and busts, Australia in the 1890s, Argentina in the 1890s are the two biggest ones previously. Again, you see very strong government subsidization of leveraging related to housing. That was also the case in the US. For example, in the US we have a whole bunch of things that tell homeowners, if you want a government subsidy relating to a house, you have to get a lot of debt. And we allow that through something called the Federal Housing Administration, which is a government-sponsored agency for insuring mortgages. With a 97% leverage allowance, we have Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac are government-sponsored enterprises. There's $3 trillion worth of outstanding subprime and Alt-A mortgages in the US. Fannie Mae and Freddie Mac are holding $1.5 trillion, half. These were agencies that were established to provide subsidies. An interesting question, though, is why did they shift their behavior so much in 2004 and 2005 toward making markets in subprime mortgages? And the answer is that Fannie Mae and Freddie Mac went through accounting scandals in 2003 and 2004. The political support for them in Congress changed, and they were under much more pressure from the Republicans, from Alan Greenspan. The only way they could preserve their political support was by investing much more in high-risk mortgages favored by the Democrats in Congress, and that pushed them very much toward being willing to take on these risks. So if you look at those two old stories about the origins of a crisis like this, it doesn't look like it's a very surprising crisis. At the same time, I'm not going to stop there. In fact, there is a new element, and it was hugely important. And that new element I'm going to describe is what I call a buy-side agency problem, which means people were willing to buy huge amounts of stuff, securities related to these subprime mortgages, make guarantees on portfolios relating to these subprime mortgages. And here's where I'm going to disagree with Patrick. They did it on purpose. And they knew that the pricing was wrong. They knew that the risks weren't being measured correctly. And unfortunately, I'm going to have to spend a few minutes of my time convincing you of that. That is, by the way, I run a bank, a very small one, not a very successful one, unfortunately. But nonetheless, I certainly knew by 2005 that this was a problem, and by the middle of 2006, I will argue everybody knew it was a problem, that the risk pricing assumptions that were made in 2004 and going forward were obviously wrong ex ante. The ratings agencies knew it, and the buyers of these instruments, who were also often the same firms that were structuring them, also knew it. They did it on purpose because it profited them to do it. They were incentivized through the way compensation worked in their companies to do this. They did it on purpose with foreknowledge. Now, they didn't know what all the consequences were going to be, but I think there is no question that they knew in advance. I knew in advance. Everyone who was involved in the markets at any level of depth also knew. This is not a retail market. You don't get to be a buyer unless you're highly sophisticated. And I will show you as much as I can in a quick time evidence to support that. So that's new. This was a massive, sure, we had the loose monetary policy, we had this big subsidization of risk through Fannie and Freddie, the Federal Home Loan Banks I didn't mention, in addition to the FHA. Half of Countrywide's portfolio was financed by the Federal Home Loan Bank system. So we had all these subsidies, we had all this loose monetary policy, so I'm tempted to say it was all government's fault. A lot of it was government's fault, but not all of it. A big part of it was this agency problem that encouraged people who knew the risk that they were taking to take it and to destroy huge amounts of value for stockholders in their institutions because it profited them to do it. Now, what about the propagation? Again, there's a lot that's old. We know what happens when you get a moderate-sized shock like this, and the thing to remember is this is a moderate-sized shock. Total losses as of, let's say, a month ago, nowadays we're in a different environment, who knows? But as of a month ago, it would have been unreasonable to expect that the total losses from the $1.5 trillion that's held in private hands could be more than 400 billion or 500 billion. This is not a very big loss. But the problem is, no one is able to tell because of the complexity of the way this was intermediated. Subprime mortgages themselves are very complex instruments, much more than prime mortgages, in terms of the way cash flows are distributed to the different tranches of debt in the subprime mortgage-backed securities. And then we built on top of those so-called CDOs, and on top of those SIVs and asset-backed commercial paper programs. And the ability, even if we know that the total loss is 400 billion or 500 billion, the problem is we have a very hard time pricing the securities that are the pieces that ultimately are backed by those subprime mortgages. So it's a very difficult problem. That's not new. That's how financial crises happen. When there's a moderate shock, even a small shock can cause confusion about its incidence and can lead to widespread increases in interest rate spreads and, even more importantly, quantity rationing in money market instruments, meaning asset-backed commercial paper, LIBOR, and repos. Money market instruments don't like to price risk, they like to run from risk, because that's what they are. They're money market instruments. When a little bit of risk happens, long before there's insolvency, you get rationing out of those markets. I do not believe Bear Stearns was insolvent in March of 2008. Long before it became insolvent, it had a run in its repo market because it was perceived correctly as being risky. So these things are very common. So what was new relative to our experience in other financial crises was three things. First, the banking system in the US actually was in much better condition than during similar shocks at the end of the 1980s or at the beginning of the 1930s. It was much more diversified regionally. It had a much wider product base. And so this moderate shock that hit it, actually, remarkably, US banks and other global international banks of similar size were able to raise, by the end of September 2008, $450 billion worth of new capital. That had never happened in a similar financial crisis. Usually, you can't raise any capital in the middle of this kind of crisis. So that's kind of remarkable. Actually, what it shows us is that the industrial organization of banking had improved in the US in the 80s and the 90s with this more diversified global system. So to weather a small shock, actually, it was better. Of course, the problem was, as time wore on, we didn't see any improvement in being able to figure out where exactly these losses were. And then we started to see, with that lack of improvement, continuing slippage, continuing loss of confidence in the system, and then things went from bad to worse. What was new about this, despite the aggressive government intervention, which was also very new, and Chris Sims talked a lot about it, and so did Patrick, very new, it still was inadequate. And despite the fact that we've seen uncertainties persist in financial crises in the past, those are typically resolved in weeks or a few months. This is now going on into its second year, where we still don't have a clear sense of where those uncertain resolutions are. That's unprecedented. And that surprised me. That's why I've been so wrong about this crisis. I expected this crisis to be over with many times by now, because I was looking historically at previous periods of crises, and they all got resolved. Why is this one so different? Because subprime instruments and the way they were intermediated are much, much more complex and therefore much harder to resolve. And I'll talk about what the policy implications of that are at the end. Okay, how much time do I have? 5 minutes, 10 minutes, 4 minutes, 6 minutes, 8 minutes. That's very nice. Okay, so I'm going to tell you why, very briefly. I'm not going to go through most of these slides in detail. I'm going to just tell you very briefly. In terms of what was the loss assumption here driven by? Subprime mortgages were assumed. This is the key thing that people don't talk enough about. You can figure this out if you go back and look. They were assumed that they were going to have a 4% expected loss in the subprime mortgage pools. That's how you got leverage up to 80%. That's how you got so much AAA rated debt, because the expected loss was initially 4%. And even by the middle of 2006, when it was clear that the losses were going to be much greater, they were not increased beyond 6%. Now, that's very interesting. What drove that? One thing, the assumption that housing prices would continue to go up even if a recession came, no matter what. What was the basis for that assumption? There was a basis. It was the 2001 and 2002 recession, and the way that subprime foreclosures losses happened during that recession. And this is what all of us who were looking at these data and looking at what the ratings agencies knew. It wasn't a secret, and you can't say that the model were so bad in the following sense. If housing prices did what these models predicted they would do, we wouldn't have had such a big crisis. Because if you look at the probability of default and the loss given default, multiply those two, you get expected loss. The probability of default is highly dependent on house prices. And the loss given default is highly dependent on house prices. And during the recession of 2001, we actually got a very large foreclosure rate in subprime, and we had very low loss experiences. The key problem was people were assuming that the house price rise during the recession of 2001 was an indicator of a forward-looking house price rise. But that was not reasonable. I'm not just saying that it was wrong after the fact. I'm saying it was not reasonable. What they did was they said, we have one recession, it just happened, and we're going to use those data to forecast what housing prices in the US do during recessions, instead of using the previous 6 recessions too. Why did they do that? Because they wanted to get an answer that was false. They wanted to get a very optimistic answer, because they all made a lot of money by pretending that that was the right answer. And the key problem there was, people blame the ratings companies. I'm going to show you some data. I blame the ratings companies. Of course, the ratings companies knew this was false. But don't blame them too much, because they did what they were supposed to do. They were serving the investor constituency. Don't say the ratings agencies fooled the investors. They didn't fool these investors at all. They published lots of data. If you were reading the ratings reports, and if you understood what was driving it, you knew that it was nonsense, that housing prices weren't going to go up forever at 10% a year. But the ratings agencies, their job is to serve the investor class, and the investor class, the people buying this, wanted that answer, and they got it. And why did they want it? Because they didn't care about risk-adjusted returns. They cared about revenues and asset growth, because they were getting huge compensation on that basis. It was an obvious error, and one that I saw at the time and many others saw. But there was no way to stop it, because the people doing the buying liked it that way. Did the regulators understand this? I don't think they did. Why? Because people at the Fed didn't really understand securitization. They really didn't. It's not, I know them, they're my friends. They understand monetary policy. They understand monetary policy. They also have some basic knowledge of banking. But the people really driving things, did they understand this market? No. Did the market participants understand it? Oh yes, all the way to the bank, they understood it. So that was a big part of the story. I would also emphasize that, again, we got things that we're very used to. It's true that confidence went away, as Patrick said, in mortgage securitization. Interestingly, though, it didn't go away in credit card securitization. Credit card securitization continued in 2007 through until very recently in 2008, because those models, those assumptions, and the way those things have been working for 3 decades had created a reputation independent of what had happened in mortgage securitization. So this was particular to the models having to do with mortgage securitization. I'm not going to spend much time on this. CDOs, I'm not going to talk about, except notice they doubled in 2006. A triple B CDO in December 2005, triple B tranche, triple B debt issued by a CDO at the end of December 2005 had a retrospective 5-year default probability of 20%. A triple B corporate debt had a retrospective 5-year default probability of 2%. In other words, if you were an institutional investor buying a triple B CDO, you knew that it was 10 times as risky as what a normal triple B means. That was before they doubled the amount of CDOs. That was before any of the crisis. By the way, things are showing up very bad as certainly by the middle of 2006. But Citibank, UBS, and Merrill Lynch, in the second half of 2006 and the first half of 2007, their originations in subprime peaked. So let's not be too forgiving of the decisions that were made in these financial institutions. And let's remember that they had very strong incentives to make these bad decisions. I'm not going to talk about this, except, I mean, the spreads got bad, they got worse, amazing things happened in spreads, but I do want to remind you of this. Quantity rationing, what I said about money markets. If you look in the middle of 2007, over the course of about a month, $500 billion came off of asset-backed commercial paper, when there was virtually nothing going on in non-financial commercial paper. This was all having to do with SIVs, asset-backed commercial paper conduits, and the huge liquidity risk that these banks were taking by having these basic working capital conduits, anything they couldn't sell coming off of their subprime originations or their CDOs, they dumped into their working capital conduits, again, very highly levered, and financing short-term with commercial paper. How could the regulators have missed this? Good question. Huge liquidity risk that didn't come out well. Of course, we made it through that part of the crisis pretty well. You can see at the end in September, we're now falling out of bed again, and that's a second stage of money market rationing. Okay, I've already talked about the whys. I want to switch now to talk about policy. I'm sorry to make you look through this. This is advertising, so you can come for the Sao Paulo discussion. I want to talk a little bit about what the policymakers did right and wrong. What was their implicit intervention rule? What sorts of short-term policies should they have followed? And what are the long-term regulatory reforms we want to consider? And I'm only going to have time to list them. I want to first talk about what they did. I think that you can defend what the policymakers did in the U.S. through the middle of September, where they, and what they were doing, particularly in phase 2 here, was they were doing what I call punishment and ring fencing. And Patrick also pointed this out. To contain the moral hazard problem, the policy rule was, when a financial institution comes to the Treasury and the Fed, you have to hurt the managers, make the stockholders suffer great loss, and then make sure it doesn't hurt the rest of the system. They did that in some extreme case, like Lehman. That's an interesting case to talk about why they did that. Again, even though that maybe after the fact we don't like the consequences of that, if you looked at the apparent, let's say the accusations of fraud in Lehman, if you looked at the fact that Lehman missed 6 months of opportunity to raise capital on its own, I think that the Treasury and the Fed had good reasons for believing that there were big advantages to not bailing out Lehman from a moral hazard standpoint. What changed on September 18th that made them change their opinion and start talking about a comprehensive solution in this third phase was not Lehman. What changed was the bear run on Morgan Stanley and Goldman Sachs stock on September 17th and September 18th. These were two institutions that had virtually no exposure to this subprime crisis. And what had happened was the very policy of punishment and ring fencing had created incentives for short sellers to run financial companies. Because if you run the financial company, they learned that the ratings agencies would downgrade the debts when the stock price went down, forcing calls on the over-the-counter positions, pushing the financial institutions into an illiquid situation. Therefore, the short sellers would make at least a short-term profit, and if it was a hard enough problem to solve, they'd have to go to the government for help. Then you'd really make your money as a short seller, right? Because of the punishment and ring fencing policy. And so that was what, in my view, caused the change toward a comprehensive plan. Now, the problem was the comprehensive plan was the wrong plan. And I think you have to understand, I think a big lesson we learned was, in spite of the fact that a lot of the Fed's particular policies, I think, were quite appropriate, that the fiscal side of the equation was based on a completely wrong-headed policy intervention idea of buying assets. I can tell you, maybe if we have question and answers, I can go into it more. It was based on bad thinking. And that's hard to believe, but it's true. We had leadership at the Treasury. I'm sorry to have to criticize the Secretary. I admire him very much, but he made bad decisions. He thought that it made more sense to avoid capital injections into banks because he regarded that as socialism. But he didn't regard buying assets at above market prices as socialism. That's the way his mind worked. To me, that doesn't make sense. Secondly, he didn't want to single out financial institutions. He didn't want some, like JP Morgan Chase, to say we don't want government help and then make others look bad. He wanted to have a convoy system like in Japan in the 1990s. That's completely wrong. And by doing that, he made JP Morgan Chase's terms had to dictate for the whole assistance package that finally came into existence, including not limiting common stock dividends enough. Furthermore, he didn't want he and the Congress thought of this as a deal, like they were playing Warren Buffett. And so they attached warrants and other compensation to try to reimburse the taxpayers. That's not what we were doing. We weren't doing a deal. We were trying to recapitalize the banks. And so you needed to do what people had done in the US in the 30s, what they did in Finland in 1992, give very low coupon preferred stock, a relatively protected position for the taxpayers, subsidize the banks through the present value of that interest rate subsidy, and help them and require them thereby to issue common stock that would match, to some extent, the preferred stock investments. Shut the bad banks down, force them to be merged, take the ones who don't want your credit, say fine, you don't need it, and the ones who do need it, give it to them in that form. But our policy hadn't been developed. We hadn't had the conversations at the highest level of our government. When economists wanted to weigh in on this, they didn't. In the week that they had congressional hearings, not one economist spoke other than government officials. Bernanke and Paulson spoke. Economists and thinking and all of the different decades of experience in other countries and our own historical experience weren't used at all. Policymakers need to think ahead. They need to develop working groups who develop these ideas and understand, if you hit a problem like this, how you're going to intervene in it. Now, we've also learned some other lessons. And these are the short-term lessons first I want to finish with. How are we going to fix this problem in the US? More capital injections? Yes. But that's not good enough. We need to fix the problem at its root, which is to resolve the uncertainty about the valuation of mortgage-backed securities. And the only way to do that is to attack the problem at its source, which is the mortgage market. What are we going to do? Taxpayer loss sharing for voluntary write-downs by lenders of mortgages with a limited time horizon, as they did in Mexico in 1999 very effectively, to encourage, to tell you, you get 40%, 50%, we'll share the loss of the write-down, but you have to do it quickly, and it has to be on a voluntary basis. That worked very well in Mexico. It could work in the US. Secondly, put a floor on mortgage prices below what anyone will even sell them to you. So Ben Steele had this idea over a year ago. Say the government will buy mortgages at 40 cents on the dollar. If you did that, you wouldn't get any mortgages. But all mortgages would now be able to borrow, all mortgage pools would be able to borrow 40 cents on the dollar because they know they have the put option of selling them to the government. Secondly, all of the death spiral scenarios having to do with mortgage-backed securities, all of the stress tests would be truncated at a 40-cent valuation, which would mean all mortgage-backed securities would rise in price significantly as a result, without having to even spend very much money, maybe nothing, on a cash flow basis. You could have a huge positive effect. And finally, I think we even need to, because consumption is falling so rapidly in the US, refinance mortgages, target mortgage rates directly, and create a huge refinancing of healthy mortgages as well as helping the ones that are in trouble. Those are the short-term things we should do, and even more importantly, since I'm worried so much about the US right now in this regard, we have to take a leadership position in preventing international trade from collapsing. This is a big problem, and the Obama administration is worrying me sick about whether it's going to play that leadership position. That's putting it mildly. We need to also fix regulatory problems. Here's my list, and this is the last page of my presentation. Rafael Rapullo's here. He's been a pioneer in thinking about how to make capital requirements more credible as well as more cyclically sensible. But we need to do more things. We've learned that we can't trust ratings agencies' grades, and we can't trust internal models by the banks being regulated. We need to find ways to bring market information in to make the regulation and supervision more credible. We can use the flows of uninsured debt, the interest rates on uninsured debt, the interest rates paid on loans to do what the Basel system doesn't do: accurately measure the risk of banks' portfolios. We can do it. We can also make ratings agencies have to provide estimates of probability of loss and loss given default. There's estimates of probability of default and loss given default, not letter grades. And if they are systematically overly optimistic about their numerical estimates for probability of default and loss given default, then they lose for a period of time their status as NRSROs from a regulatory standpoint. There are ways to fix this problem if we want to. Finally, we want to reform over-the-counter disclosure and accounting to encourage more transactions to happen on exchanges, which makes the transactions more transparent, makes the measurement of net risk positions greater, and also avoids counterparty risk that's in the over-the-counter market. More than 80% of over-the-counter transactions are plain vanilla swaps that could be easily cleared on a clearinghouse. Why aren't they? Because banks earn higher fees for over-the-counter transactions than for clearing transactions. How do we encourage banks to do the right thing? By increasing our disclosure and accounting requirements on anything that's over-the-counter. That will gently push the swaps, the plain vanilla swaps, onto the exchanges, and then if something really needs to be customized, it'll still be over-the-counter. Finally, we need to get rid of the Fannie Mae and Freddie Mac and similar kinds of entities that are subsidizing huge leverage in the housing market because they are going to be a continuing risk if we don't fix them. And then finally, I would say, if I had more time, I'd talk about some of the innovative ideas coming out of Spain and Colombia about how to deal with credit booms. Now, because of the moral hazard problem of government protection, relative to where we were 30 years ago, one of the major threats that we have is credit booms riding a systematic risk of a big bust, because there's where you know you're going to be protected. In fact, my own policy advocacy means that as long as you're riding that big risk factor, you get protected. So it can give rise to big, unwarranted asset bubbles driven by credit booms. And so we have to have ideas about how to create macro-prudential responses to this problem. In Colombia, very importantly, in 2007, they increased their provisioning requirements and they increased their bank reserve requirements so both capital went up and liquidity went up because of a concern. I'm done. I'm almost done. Because of a concern that credit growth was happening at 30% at the end of 2006, and GDP was growing at 8%. The current account deficit doubled from 1.6 to about 3.2%. And they said, we have to cool this down. And then they succeeded in doing it. And boy, are they glad they did. So I think we don't all know exactly how to do that, but we know that we have to do it. So regulation has to bring credible information into the measurement of bank risk, especially information from markets that's credible. We have to, I could talk more about all the research about how to do that. We have to fix the over-reliance on over-the-counter markets. We have to get rid of the subsidization of risky debt in mortgage markets, and we have to start adding a little bit more sophistication to our cyclical prudential supervision. Thank you.
Thank you very much, Charles. The last speakers before the governor will be Jean-Charles Rochet from Toulouse.
Thank you very much. Good afternoon. After this very interesting analysis of the crisis and the way it was managed, I would like to focus on the future of financial regulation and banking regulation, and to follow up on Charles' suggestions. In other words, the question I would like to address is what should we do to limit the frequency and cost of the next financial crisis, not this one. And my punchline is in fact two parts. One is that political economy considerations are crucial in the understanding of financial and banking crises, and this one is no exception. And second, the focus of banking supervision should be completely changed. On the first aspect, namely the political economy consideration, many people, many commentators, including Patrick a few minutes ago, have underlined the total absence of preparation of banking supervisor vis-à-vis a systemic crisis. I believe the whole banking supervision system, and in particular Basel II, was totally focused on how to manage the failure of individual banking institution, and that there was nothing on how to manage the failure of the global financial system. So as a result of that, as a result of this lack of preparation of banking supervisors, politicians have been obliged to step in, and they have done that in a disorderly fashion. And this is obviously a big danger. So in the future, I believe we should try to avoid this kind of situation. And I believe that the only way to limit the probability and cost of future banking crises, because there will be banking crises in the future, is to create truly independent supervisory agencies endowed with the power to close down banks before it's too late, and also to take actions in order to preserve the stability and the soundness of the infrastructure, the financial infrastructure that is crucial for our economies. I would like to remind you that central banks have been granted independence for monetary policy, essentially because of the impossibility of governments, of politicians, to commit not to print money in order to finance their budget deficits. So I believe in the same fashion, it's impossible for politicians to commit not to intervene, not to bail out insolvent banks, and not to protect the financial sector in case of a problem. And therefore, you need to provide the ways of action to an independent authority. But I would like to come back to this question of the focus of future banking regulation, because I think that's crucial. I think this focus, instead of being in what is called micro-prudential regulation, that is how to deal with the failures of individual institutions, it should be on preserving the safety and soundness of what I call crucial financial structure in general. Large banks, but also, infrastructures, payment systems, stock exchanges, derivative markets, and so on and so forth. So it's not easy to do that. And I do not believe in particular that it's feasible to regulate and supervise all the financial institutions that participate in these market infrastructures. In particular, hedge funds. Many journalists have suggested that hedge funds should be regulated, but I believe that public authorities will never be able to prevent financial contracting between, private institutions or private investors in Cayman Islands or elsewhere. So what is important is to identify the core of the financial system, the institutions and infrastructures that government are decided to protect in all circumstances because they are vital to the economy. So let me use two analogies to illustrate these ideas. Maybe you find them a bit too simplistic, but I believe they capture a part of the crucial ideas. I think that financial speculation is a bit like tobacco. That is, a little bit of smoking can be a temporary pleasure for some of us. But we all know that too much smoking is bad for one's health, and more importantly, it's bad for the rest of us, the people around us. So how can you avoid these negative externalities? Well, I don't believe prohibition can work. Examples of prohibition have failed in the past. It would simply encourage crime and all kinds of illegal activities. No, I think the only reasonable thing to do is simply to prohibit smoking in public places, right? So I want to suggest the same kind of idea for financial speculation. I believe there is a certain number of financial institutions that are crucial for the functioning of the economy, okay? This is what I call the public part of the financial infrastructure. Therefore, I suggest that you do the same for financial speculation for smoking. That is, essentially, you prohibit using toxic financial assets or having toxic financial activities in the public part of the financial infrastructure. Of course, it means that you want to regulate more actively what's going on that, but also you want to avoid contagion by outsiders from outside the system. The second analogy that I would like to develop, maybe again it's a bit too simplistic, I believe that the subprime crisis, in a way, could be characterized as the Chernobyl of structured finance, right? You see, securitization is in principle a very good financial innovation because it allows banks to produce much more credit with much less capital. In the same way that nuclear technology allows you to produce a lot of electricity with very little fuel. What has happened is that the remuneration scheme of the engineers in the new securitization technology were based on the volume of their activities. That is, the more loans that loan brokers would grant, the more assets were securitized by the issuers, and even, as Charles indicated, the more funds, the more money was invested by the banks who had the delegated management of the investors, of final investors' wealth. All this was remunerated essentially on the basis of the volume of the activity and not on the quality and the risk-taking associated with activity. So what do you think would happen if the engineers in charge of the management of the nuclear plant would be paid proportionally to the volume of activity of the plant, that is the amount of electricity that is produced? Well, they will try to run the plant as much as possible, and that would increase, of course, the probability of a big risk, a big accident. So does it mean that we want to ban securitization or nuclear plants? Some people think we should. I do not. I think that nuclear plants, when they are well managed, and securitization are very good instruments to improve the efficiency of our systems. But they have to be run under extremely strict safety procedures, and not only that, but also that the risk of accident has to be very well understood, and procedures have to be specified in advance should a nuclear accident occur. So this is exactly the same type of recommendation I would like to put forward. That is, systemic risk happen. I mean, this is a good illustration. In the past, in the 20 years before, the last 20 years of the 20th century, there have been many financial crises, but there was no systemic crisis for the entire financial system of the planet. These things can happen, and they can happen again in the future. So what we have to do, I believe, is to be able to define procedures in order to react promptly, and not exactly that was suggested by Charles and also Patrick, that if politicians do the job, what they will do typically is try to delay as much as possible, and also try to yield to pressures by interest groups and the general public. So this you want to avoid in the future. And for that, you need completely to redefine the agenda of financial regulation and focus it on the management, the prevention and the management of systemic crises by independent regulatory agencies. Thank you very much.
Thank you very much, Jean-Charles. We have a couple of questions, but before, let me make a couple of comments. I heard some very interesting comments by John Giannakopoulos yesterday. For example, he was suggest that we should redo the way you regulate collateral in the housing market, for example. Perhaps you should make it easier for a negotiation. Before, right now we have this pooling of mortgages, which makes the renegotiation procedure much more difficult because of you don't have one person in charge of, like a bank or something like that. So that's a quick regulation that could help. solving the mortgage problem. That's where this thing began. Also, I agree with Chris Sims that's mentioned that we extended ourselves perhaps too much on this fiscal side, so the macro side. So we should go deeper in the regulatory, but it's not easy solution. We have a lot of thinking now about how to regulate from now on to avoid bubbles, although bubbles is not that easy to detect. It's much easier to detect exposed credit booms and so forth. But I think that we need some more regulation, and don't know exactly what to do. And I think we should, I believe with Charles that we should have a whole bunch of microeconomists thinking how to solve this particular crisis. And right now, before, what was different in this crisis, that before I have crisis with perhaps in this size of the economy with the trillions of dollars of bad toxic asset. This time we'll have hundreds of trillions. So it's much more difficult. And some people suggest bankruptcy law for banks, but we don't know how to do it. And some people suggest massive intervention on the contracts to undo it, but that could be very damaging in the long run, although in the Great Recession they did that. And but to have to do some serious thinking about this, how to solve it from the regulatory point of view. So I passed a couple of questions before passing the last word to the Governor of Central Bank. So any question from the floor? Could be addressed to any of the speakers.
What kind of assets you have in mind? What kind of institutions? For example, I was thinking, okay, we should not allow big institutions to buy CDOs that have a default risk of more of 5%, 10%, and how big is big? No, I mean.
Which related to the notion of maximum safety, right? So it's the idea that financial innovation is good, but it takes time to check that it's safe, okay? So what I have in mind is the securitization business is really something that has been elaborated in the recent years, in particular the complex structured product, because securitization has been going on for several decades now, but the complex, structured products, vehicles that have been designed, they have never been experimented anywhere. And they have been experimented in the public, banking sector, the banking sector that is protected by public authority. I want them to do their experiments elsewhere, and then when it's proven to be safe, maybe they can be adopted by banks. It's a bit like, the authorization for new drugs. You don't want the drugs to be distributed to everybody like that before they have been proven to be, safe. You have to wait. So I suggest something of the form.
Any other question? We also could have a question from one of the panelists, another one, or any comment?
I have a question. Both Charles and Patrick talked about the unusual slowness of fiscal intervention in this crisis. And I'd just like to raise the question of whether this might be a side effect of central bank independence, at least the way it's been understood. That central bank independence has been understood, I think, in a naive way. If you look at the European Central Bank, it seems to be set up to make it impossible to talk to fiscal authorities. In fact, there isn't one fiscal authority. Central banks are able to move quickly, and in previous historical periods, or in some places where central bank independence is not so clearly defined, it becomes possible for the central bank to quickly take actions that have fiscal consequences. Now central bankers are very aware of the distinction between an action which has fiscal consequences and doesn't, and are very reluctant to take on actions that have fiscal implications. Lars Svensson told me that the previous version of the Riksbank's founding documents contained a provision that if the Riksbank's balance sheet ever went negative, the Treasury was to supply securities to recapitalize it. But this was eliminated in the name of central bank independence. It's the kind of understanding of central bank independence that I may think may be causing us problems now and needs to be rethought.
I want to comment on that. I think that point is really interesting. I think the way I would put it is, we want to have regulatory structures, institutional structures that are mindful of political economy, as we all agree. The problem is, solving one political economy problem might create one institutional structure that's not very well attuned to dealing with another problem that arises. The problem is that even though we had specific history in the US in the 1930s, where central bank interventions didn't work, then we created the preferred stock program of the Reconstruction Finance Corporation. It took about 2 years to get there. Well, we did it again, except we did it worse maybe this time for all the reasons we talked about. Actually, I wouldn't say it was so slow, it was just not very wise. The problem is, I don't really want the Fed to be doing that. But what I do want, this is my idea of the solution, is I think that the Treasury and the Fed and the other agencies have to have discussions about these issues and basically have a sense of somebody within their organizations who's knowledgeable about this. It's ironic. The IMF recently has sent people to the U.S. Treasury to help them think through the second wave of the TARP. Because why? Well, because people at the IMF and the World Bank have been dealing with these issues. Patrick has for decades. I have, working with Patrick and others at the World Bank and the IMF for decades. We write about it, we think about it, but at the U.S. Treasury and at the Fed, it's not their issue. So I think the answer, Chris, is not so much to change the separation of the central bank as to have part of the sort of currency of thinking, of intellectual capital at these organizations has to be familiarity.
Any other comments from the panel? Okay, so pass the word now to Henrique Meirelles, the governor of the Brazilian Central Bank.
Well, thank you, Professor Aloisio. It's a pleasure to be here. At this point, I think that it would be interesting to first provide a very brief overview on how this overall situation is evolving and it's affecting Brazil, number one, quickly, and then move on to some recommendations achieved during the meeting of central bankers and finance ministers couple of weeks ago, and then move on to address, in short, some of these regulatory challenges that we're talking about here. In terms of Brazil, although third quarter GDP data was still not released, lead indicators suggest that the Brazilian economy continued to grow briskly up to September, Domestic demand has been the source of GDP growth in recent past, with external demand contributing in a negative way to GDP. Year over year to second quarter, household consumption grew by 6.2%, whereas investment grew by 16.2%. Household consumption has been supported mainly by favorable and strong labor market conditions, improved access to credit, and high consumer confidence, and to a lesser extent by fiscal transfers of the government. The collapse of Lehman Brothers, as you would guess, in mid-September represented a turning point to this chain of events in Brazil. The leading channel of transmission was of a deteriorating scenario externally into the domestic one was credit, international, basically cross-border interbank lines. Basically, there was a near interruption of international trade lines to most countries, including Brazil. As a matter of fact, rollover rate fell to 20%, 30% at some points of the pre-Lehman levels in some cases. Risk aversion was a second relevant channel of contagions to Brazil as well as to emerging markets in general, deteriorating confidence translating to higher net capital outflows. For instance, repatriation of portfolio investment as a result of withdrawals and deleveraging in some funds, particularly hedge funds, corporations which had to repatriate cash in order to meet demands of their head office, some of the well-known companies and so on and so forth. Given the higher liquidity of Brazilian assets vis-à-vis other emerging market economies, the process was likely more intense here. In consequence of the process, Brazil's sovereign spread rose to levels not seen since 2004. A third channel of contagions was evidently falling commodity price. It's relevant to say that the direct external demand channel appears less significant for Brazil than for other emerging economies, as the Brazilian economy is still relatively close to international trade and is probably more diversified than many, a fact that explains why Brazilian GDP continued to gain momentum up to third quarter of 2008, contrarily to other economies in the emerging markets, where the business cycle reversed course earlier in the first half of 2008. The sudden stop of international credit lines, lower commodity prices, and growing risk aversion contributed to depreciate the Brazilian real. Identification of foreign exchange volatility, intensification of that was also a consequence of the fact that many large Brazilian exporters, stimulated by a long period of exchange rate appreciation and low volatility in a phenomenon not that much different than someone you described, had hedged their export revenues with sophisticated derivative contracts. As the exchange rate depreciated and surpassed certain strike prices, those companies or their counterparties were forced either to margin calls or to unwind their short position in the foreign exchange market, putting additional pressure on the currency. By mid-October, volatility had increased substantially. On the other hand, Brazil was better prepared for this crisis than it had been in the past for a series of conditions. The country had accumulated in excess of $200 billion of international reserves. Central bank had a long position in foreign exchange in the futures markets. Brazil, particularly the sovereign, is a net international creditor in foreign currency, so that when there is a depreciation of the real, the net sovereign debt declines as a percentage of the GDP or even in absolute terms. As a matter of fact, the net sovereign debt to GDP ratio declined from 40.5% in August to around 37% by the end of October. The capital adequacy ratios of the banking system was higher than the international standards, and what is recommended by the Basel Committee is higher than the average. Brazilian banks were not exposed to the U.S. credit market. Banks had no foreign exchange mismatches or liquidity mismatches in a substantial way as a result of prudential regulations which had prevented that to happen. Although the central bank do not have a target for the exchange rate, it responded, though, to the foreign exchange developments through two main courses of actions: a set of initiatives aimed at injecting liquidity in the market and initiatives aimed at reducing volatility. Regarding the injection of liquidity, the central bank approach was twofold. Injection of liquidity to the market in general, dollar market mean through sales of dollars in the spot market. In spite of that, reserves remain above the $200 billion level. In order to replace the sharp drop in interbank cross-border line, the central bank adopted more specific action to finance exporters with dollar loans, collateralized with either Brazilian global bonds or export receivables. Now, only with export receivables because they are a source of foreign exchange as well. The total amount of sales to the market so far amounts to around 18 billion, of which about 12 billion corresponds to loans, which don't affect the reserve liquidity. Of course, this policy was only possible due to a significant accumulation of international reserves. That had reached about 15% or more of the GDP before the crisis. Also, on the volatility front, an initiative that was facilitated by the long position in dollars in the local futures market in amount of about $23 billion at the time of the Lehman collapse. Central bank eliminated its long position gradually, and that it acted against a liquidity distortion in the futures market. Still on the external front, the central bank announced a currency swap line with the Federal Reserve of up to $30 billion. In consequence of all these initiatives, advances on export contracts have recovered somewhat, and volatility has somewhat declined, although not yet to the pre-Lehman levels. The most important problems in the derivatives are already resolved, but now we have a serious one which are more in line with the export capacity of the companies. On the domestic front, central bank acted to restore interbank liquidity and normalize the domestic credit market. The fact that in Brazil, banks' reserve requirements are relatively high for international standards facilitated the task. We announced a decision to release as high as 100 billion reais in requirements and gave incentives for large banks that have a more stable deposit base to acquire portfolios of small and medium-sized banks, which are more dependent on the interbank market. We are now seeing a gradual recovery of credit concessions after sharp contraction in the beginning of October. The fact that public banks still account for a significant share of the Brazilian credit market and have been restricted throughout the years contributed to this recovery. Although credit conditions still did not fully return to the pre-crisis level and consumer confidence eroded since October, labor market continues to anchor domestic demand so far. The central bank will publish by the end of December its 2009 GDP forecast. Brazil will likely decelerate, as many analysts are foreseeing, but estimates are that Brazil is going to grow above the world average. IMF is one of the estimates, for instance. Before continuing, just a few words on international cooperation. As I mentioned, central bankers and finance ministers met 2 weeks ago in São Paulo of the G20, and then the heads of states met in Washington. It's clear today that the G7 alone, or even the G10, are not able to address all relevant issues that affect the world economy. Evidently, there is always a trade-off. The larger the group, the more difficult its effectiveness, but that is a challenge that we have to face. The G20 committed itself to implement reforms along the lines of what's being discussed, including here, commitment to reform the IMF and the World Bank to increase their legitimacy and effectiveness has also progressed, grant a larger weight in their decision bodies to emerging economies. It was decided to expand the representation of the Financial Stability Forum and of the Basel Committee of Banking Supervision. As emerging market economies are playing a more important role in the growth in the global economy, it's imperative that these countries have a proportional weight, and I think that that is moving on. Now, talking about moving on to regulatory issues, Professor Calomiris referred to the macroprudential regulation that some countries are now have implemented and the discussion which is taking place. Yes, that is a discussion which is indeed taking place and it's becoming more and more important. Yesterday, the day before yesterday, in the European Banking Congress in Frankfurt, we had spent some time on that, and the Spanish governor Governor Ordóñez made a very detailed explanation of the way Spain, for instance, is addressing the question. First, the question is how that portion of the equation affects the crisis. Number one, the excessive leverage of economic agents, and second, the weak position from which financial institutions face the downturn. On one hand, due to the problems stemming from excessive credit growth. On the other hand, because banks do not take advantage of the expansion years to build up reserves or provisions that they should. With less leverage and greater resilience on part of banks who would not evidently avert cycles, but we might experience more orderly ones, we hope. During cyclical downturns, a breeding ground for excessive optimism, that was stressed here more than once, and subsequently the widespread underpricing of risk tends to develop. The financial markets behave as a risk falls during upswings and grows during recession. We know that, we know how that reasoning works, how the models work, I mean, that's clear, but it's curious. Why? It's curious, for instance, to see how the usual indicators of risk premiums, such as the credit default swaps, bond spreads, and so on, tend to reach the bottom around cyclical peaks. However, the reality is quite different. During recessions, risks do not increase, they simply materialize. And they do so after having been built during the boom. When the downturn sharply curtails optimism and borrowers and lenders suddenly revise their expectations, the full scale of the imbalances that have built up emerges, triggering financial pressures that fuel and are in turn fueled by the cyclical slowdown, setting a vicious circle that ends in the crisis. That should be of particular concern since it's important to note that even as it was mentioned in the case when monetary policy is successful in containing inflation, it can also contribute to increased household and corporate leverage. A successful inflation-fighting monetary policy, for instance, managed to anchor inflation expectations, particularly in countries with a longer history of price stability. In such a setting, the demand-driven process can accelerate in the sense that that could incentivize the higher leverage. That, again, calls for macroprudential measures. The resilience of the financial system in general and of credit institutions particularly plays a key role in softening cyclical downturns. Evident in this crisis has been the weakness in which many banks have faced the downswing. To increase the resilience, bank regulation policies should curb the pro-cyclical behavior of credit so that it protects banks and prepares them for the crisis. I will now refer to some counter-cyclical system of provisioning which might or might not have some of the features of the prudential regulatory mechanism of dynamic provisioning, which was, I understand, already discussed here in previous days. As you know, the discussion now evolves towards the development of regulatory policy instruments that enable credit institutions to recognize during upswings the higher level of credit risk accumulating in their balance sheets. We must have a provisioning system that achieves this recognition. The idea is that banks should set aside provisions for loan losses when the risk is assumed. This means that the provision must increase, for instance, a percentage of loans, the faster the credit growth, the longer the term, the higher the loan-to-value, and so on and so forth, the more complex, or all the other features that could be added to that provisioning structure. They will then be able to use the provisions during the downswing when the risk materializes. We don't have in Brazil the kind of statistical dynamic provisioning system that I am referring to, but I am convinced that higher levels of provisions, when compared to international standards, have significantly strengthened the solvency stability of the Brazilian banking system, both on aggregate and at the level of each institution. Clearly, this provision did not insulate institutions from the global crisis, but it had certainly positioned them somewhat better to withstand it. I would not like to end before mentioning that among some central bankers, that has been calls in recent years for the introduction of financial stability considerations into monetary policy design and implementation. That's a discussion which will go on now, I am sure. Finally, but no less importantly, we should enter into international agreements to ensure that counter-cyclical mechanisms are applied consistently in all countries. A global banking system requires uniform and internationally coordinated responses. Thank you very much.
Thank you very much, Dr. Henrique Meirelles, the Governor of Brazilian Central Bank. And we finished the session and the Congress, LACEA-LAMES 2008. I'd like to thank everybody who was present here, my co-chair that were just here on the left, and then the